Hi there, I'm Matthew Lester at the Rhodes Business School. Some of you may have heard that there are moves afoot to change Provident funds with effect from 1 March 2015 to bring them in line with other types of retirement funds. What's going on here, and is there a need to panic? Let's go back on the employer-employee relationship over the last 20 years. 20 years ago, your employer provided you with your life, disability and sickness benefits, your medical aid, generally on a 50-50 basis, and a defined benefit pension fund from which you would retire at about age 65. Over the last 20 years, this has undergone substantial change as we have moved employment more or less to a basis of cost to company. You can have whatever benefits you like, but you are going to pay for them. This has substantially changed the way that we look at defined benefit pension funds. In the past, we used to get a defined benefit pension fund, but now we're going to a new basis because we're saying to the employee, you can have a pension fund or a provident fund, or you can provide for your own retirement in a retirement annuity fund. There are also benefit funds which take over balances from the other three funds. The basic concept is that if you have a defined benefit pension fund, you can only withdraw 1/3 of the actuarial value on retirement. However, if you have your own provident fund, it's all yours. You can take 100% of the accumulated benefits and disappear. And if you want to buy your family a coffee shop in George, well then, good luck to you. A retirement annuity fund is similar to a pension fund in that you may only draw 1/3 of the accumulated benefit, and benefit funds, the character of whatever was put in there is retained. Now the big change that is happening is with Provident funds from 1 March 2015, they are going to say the 1/3 commutation rule applies, i.e. you can only draw 1/3 in cash, the remainder has to buy you an annuity. But in implementing this new rule, there are a lot of softening provisions. So they say take a Provident fund. First of all, if you are over 55 on 1 March 2015, you won't be touched by this new amendment. You may still take the full 100% benefit. No annuitization need be applied. And then there is a de minimis rule which says that if your fund is less than 150,000 Rand, well then you can still take the total capital regardless. However, if you are below 55 on 1 March 2015, then pay attention. It gets a little bit complicated because your benefits prior to 1 March 2015 plus accumulated growth thereon will be accounted for separately by the fund managers and will remain untouched. You can still draw the total amount on retirement. However, any benefits resulting after 1 March 2015 plus growth thereon, you will be required to annuitize 2/3 of the balance. Unless the balance is less than 150,000 Rand, then you can take the whole amount. People joining a fund after 1 March 2015 will be required to annuitize 2/3 of their provident fund. Oh dear, everybody cries. Just when we got to budget 2014, we see that the taxation on lump sum benefits has been eased a little bit. We can now draw 500,000 Rand tax-free in retirement, and the first threshold, which is taxed at 18%, runs all the way up to 700,000. The higher rates of up to 36% are then applied from 1,05 million. People have always enjoyed these lump sums, and now they think that the world has changed. But actually, it's been changed for some time. We just haven't realized why. We need to have a look at withdrawal benefits from all retirement funds and say the following. When you look at a retirement fund, you are investing a tax-deductible contribution at up to 40% discount. These contributions will be capped at a maximum of 350,000 or 27.5% of taxable income from the 2015-16 year of assessment. However, once your money is in the fund, it grows tax-free. All retirement funds have now become a tax haven. And it goes even further in that no CGT or estate duty will be applied when you die. When one looks at the claims made by SARS that the average tax rate of South Africans has reduced from almost 35% in 1994 to about 18% today, one can get skeptical. One can say that we are taxed on a far wider range of fringe benefits. But when it comes to pensioners, they don't have fringe benefits. Thus, they have benefited substantially from the widening of the tax brackets since 2000. In the 2014-15 budget, they widened the brackets even further, granting a further 9 billion rands worth of relief, mainly at the lower end of the tax table. This is where you're going to live, believe it or not, or most of us are going to live when we are in retirement. We're going to pay a lot less tax. So when one looks at retirement fund withdrawal benefits, what we're saying is this. Yes, take a lump sum on retirement of up to 700,000 Rand because it makes absolute sense if the tax rate is below 18%. However, then start thinking. Using the living annuity principle, limit your withdrawings from a retirement fund to create taxable income that will utilize the lower tax brackets and rebates, and then draw a little bit more that will be covered by the new medical rebate, which is based on a 33% inherent tax rate if you are over 65. The remainder should remain within the sanctuary of the retirement fund and grow tax-free until it is needed. And if anything's left, well, those death benefits can be passed on to your beneficiaries outside of your estate and exempt from estate duty. That's pretty neat, isn't it? Now, if one takes this all into a computation and says, well, I'm going to need 500,000 Rand a year for retirement, the big problem is how to generate 500,000 Rand a year. But presuming that we can, if the 500,000 Rand of income in a year can be structured as follows, we say take 400,000 Rand out of your retirement annuity fund using the living annuity principle. You'll also have some cash. Let's say you've got 1 million in cash. That will generate about 50,000 Rands worth of interest. And you might have some private investments which would deal another 50,000 Rand in capital gains. So that totals the 500,000 Rand starting point. But the deductions for the retired pensioner are something else. Because first of all, we get an enhanced interest deduction, 34,500 Rand worth of tax-free interest, and then another 30,000 Rands worth of tax-free capital gain every year. The resultant accumulated capital gain, only 25% of it lands up being taxable. Then we get to taxable income and we work out the tax thereon. But there's still good news to come, because as a pensioner you will get the primary rebate, then the age rebate, and then the new medical rebate on your medical expenditure. I've put in 70,000 Rands worth of medical expenses a year, which for two people in retirement is quite plausible. All of this scenario boils down to an average tax rate of 12% on 500,000 Rand. And as we say in the classics, that's not too shabby nige. So what's changed? We've changed from an era where we used to look to take lump sums on retirement to a new era where we want to take annuity income and control the flow of gross income to the pensioner. In that way we can manage the tax rates down to a very acceptable level. This is a complete change from 20 years ago, and it actually is supported by the new view of Provident Fund benefits are going to have to be annuitized. So there you have it. Provident Fund alignment from next year is not going to have an adverse effect on many people. In fact, for some it might bring some relief. I'm Matthew Lester at the Rhodes Business School. Thank you for your attention.